Okay, so hello and welcome everyone to this session of financial management F9. Okay, now what are the purpose or objectives of these particular sessions, which are usually conducted before exams? Now, as we all know, that there is, we all are familiar with it, that if we talk about our examination past papers. Okay, if we talk about examination past papers, so usually MCQs and MTQs are not published. I used to say these things in many of my sessions, but obviously you all are familiar with it as well, that MCQs and MTQs are usually not published in the past papers. Okay, usually long questions are published, so there are always students running after their respective tutors, that how can we practice the MCQs, how can we practice the MCQs. And the tutors usually tell them, okay, for MCQs, MCQs preparation, you can go and follow the, let's suppose, Kaplan kit, and you can solve the MCQs, MTQs there and go in the exam. But there has been a general concern and consensus among students that when they do the Kaplan kit, or let's suppose BPP kit, to prepare their MCQs and MTQs, they always complain that when they go in the examination hall and they see the MCQs, MTQs, they are usually very, very different from what kit is mentioned. They say that this is not the case about long questions, because long questions are similar to what we practiced. Obviously, because long questions are being published. So when long questions are being published, the tutor knows, the kit knows, everyone knows that what exactly the examiner pattern. They publish the past papers, make the practice questions according to that, and you're very, very comfortable with section C. But MCQs and MTQs are not published, so people prepare their own. And students complain that it's very much different from what we are facing in the real exam. So to overcome this issue, I personally started some research about MCQs and MTQs and tried to gather some examination MCQs and MTQs from different sources of ACC. Okay. Now, up till now, I have prepared 5 videos on MCQ and MTQ. Okay, 5 videos I have prepared on MCQs and MTQs, and these videos are available on my YouTube channel named Ahmed Shafi. Okay, people who have taken the regular course from me from across the world, they have already seen these videos. They are available as a part of their course, but obviously when examination is close and you want to help students who even haven't studied from you. So what we have done is that I have made 5 videos on MCQs, MTQs. They're available on my YouTube channel named Ahmed Shafi. The name of these videos is F9 FM Financial Management MCQ session 1, then session 2, then session 3, then session 4, then session 5. Okay. If you just want to have an idea, I can show you them as well. You can go in videos on my channel and you can just search on financial management. Okay, so there are a range of videos on financial management, but specifically talking about the MCQs. See, this is the first one, F9 FM Financial Management MCQ session part 1. Then F9 Financial Management MCQ session part 5. Then F9 Financial Management MCQ session part 4, F9 Financial Management MCQ session part 3. And then F9 Financial Management MCQ session part 2. There are 5 videos on my YouTube channel which covers extensive MCQ and MTQ practice. And in today's webinar, what I am going to do is I am conducting F9 FM Financial Management MCQ session 6. So this is the 6th class which I am preparing to help you out and make sure that you are comfortable with the MCQs. Now, as far as I remember, I have approximately solved 10 to 15 MCQs or maybe 10 to 12 MCQs in every session. These are real exam MCQs, not your kit MCQs. Okay, real exam MCQs, not made by tutor. They're real exam MCQs, okay, published by examiner, gathered from different sources. Okay, so when you talk about these, see 12 MCQs per video, and this is the 6th video. If you watch them, there is practice of 72 MCQs and MTQs. Now, if you go and just check your kit, there will be what, 100, 150 MCQs. And you people complain that when I go and sit in the examination, all I find MCQs in the real exam totally different. So you are getting practice of 72 MCQs through these 6 videos. So my strong advice to all of you is that once you take this session, today's session, obviously in today's session also I will solve 10 to 12 MCQs, okay? And once you are done with today's session, okay, definitely go to the YouTube channel. Watch those 5 videos. If you don't want to watch it now, no, okay, no problem. You still have 4 to 5 days in your exam left. But my strong advice is that do watch these MCQ videos, all 6, before one exam. And trust me, obviously we have made a WhatsApp group as well. After the exam, you people will share your feedback on that WhatsApp group, that whether you found MCQs very easy after seeing my videos, and if you're lucky enough, trust me, you might get few MCQs right from these 6 videos in your real exam as well. Okay, so this is a very good practice material. Okay, so without wasting time, we should start now. Okay, we will be doing MCQs from an MCQ file. I have already shared that MCQ file on the WhatsApp group created, so you can also see the MCQs on the screen, and you can also refer from the file which has been shared on the WhatsApp group. Okay, so without wasting further time, we should start doing these MCQs now. Okay, MCQ number 1. Okay, Trite Limited is a listed company which has 800 million shares in issue. Okay, so the first point, company is a listed company. It has 800 million shares in issue. Yesterday, the ordinary share price closed at 6. So yesterday, the closing share price was 6. 2 days earlier, the board of directors approved the launch of 2 new innovative products, but this has not yet been publicly announced. Okay, yesterday share price closed at 6 yesterday. Okay, 2 days earlier, board of directors 2 days earlier approved 2 new innovative products, but this has not been announced. The first new innovative product was produced as an NPV of 40 million, and decision to launch A will be announced publicly tomorrow. Product B has an NPV of 160 million. Remember, there were 2 new innovative products. So product B has an NPV of 160 million. The decision to launch product B will be announced publicly this morning. So for A, you will announce the decision publicly tomorrow, but for B, you will announce the decision this morning. And yesterday, the share price closed at 6. Assume all other things are equal and the capital market believes the projected NPVs, both products will be financed using internally generated funds. Assume all other things are equal, capital market believes the projected NPVs, the markets trust the NPVs, both products will be financed using internally generated funds. What will be the ordinary share price at the end of today? Yesterday it was 6. Okay. What will be the share price at the end of today if capital market number 1 is semi-strong form efficient and number 2 it's strong form efficient? Okay. I will just read the question again for your better understanding, but this topic relates to weak form efficiency, strong form efficiency, semi-strong form efficiency. You must have a sound grip on the concepts of weak form, semi-strong form, and strong form. Let's just quickly recap this. That when you say markets are weak form efficient, that means they have already incorporated the effect of past price movements. Okay. When you say markets are semi-strong form, that means they have incorporated past price movements and publicly available information. Okay. And when you say markets are strong form efficient, that means prices have already incorporated past price movements, publicly available information, and insider information. I'm sure this is the concept you might have read, that when markets are weak form efficient, that means they get affected by past price movements. Okay. When you believe markets are semi-strong form efficient, they get affected by past price movements and publicly available information. And when you say markets are strong form efficient, they get affected by past price movements, publicly available information, and insider information. Now, let's just twist the facts a bit. And students who have studied from me, I have twisted these facts. When markets are weak form, they get affected by past price movements. They already incorporate, past price movements. That means prices can get affected by publicly available information and insider information. Okay. When you say markets are semi-strong form, that means share price already incorporate past price movements and publicly available information. That means price can get affected by insider information because two things are already present. So price can get affected by insider information. And when you say markets are strong form efficient, prices already incorporate past price movements, publicly available information, and insider information. That means price will not be affected by anything. Okay, there are three things, right? Weak form efficiency says that prices already incorporate past movements only. Semi-strong form says they incorporate past price movements and public information. Okay, and strong form says they incorporate past price movements, publicly available information, and insider information. So three things. Now, if you say in weak form that prices get incorporated by past price movements, prices already incorporate past price movements, only one thing. That means they can get affected by publicly available information and insider information as for weak form. Semi-strong form says prices already incorporate past price movements and publicly available information. That means prices have already incorporated past movements and publicly available information. Still one thing is left. They can get affected by insider information. And strong form says that prices have incorporated past movements, publicly available information, and insider information. So prices have already incorporated all these three things. So nothing is left. Price will not be affected by anything. Okay, this was revision of the concept. Now come back to this question. Tride is a listed company which has 800 million shares in issue. Triad is a listed company that has 800 million shares in issue. Yesterday, ordinary share price closed at 6. So yesterday, last day, share price closed at 6. 2 days earlier, the board approved the launch of 2 new innovative projects. This has not yet been publicly announced. That means it's still insider. Okay. Yesterday, the ordinary share price closed at 6. Okay. Yesterday, share price was 6. 2 days back, board of directors approved the launch of 2 new innovative projects, but this has not yet been publicly announced. That means it's still inside. Okay. 2 products. A has NPV of 40 million and it will be announced publicly tomorrow. Okay. We will announce tomorrow. And product B has an NPV of 160. Decision to launch B will be announced publicly this morning. Okay. Assume all other things are equal and that capital market believes the projected NPVs, both products will be financed using internally generated funds. What will be the ordinary share price at the end of today? What will be share price at the end of today? Yesterday it was 6. What will be share price at the end of today? Yesterday it was 6. What will be the end of today? If markets are semi-strong form and strong form. Now, if markets are strong form efficient, please pay attention. If markets are strong form efficient, they don't get affected by anything. They already incorporate, the prices already incorporate past movements, publicly available information, and this insider information. This has not yet been publicly announced, it's insider. So when markets are strong form, they already incorporate all these 3 things, even inside. So they don't get affected by anything. So whether you make this announcement today, tomorrow, whatever, in strong form, the prices won't be affected by any of these. So in strong form, the price would still remain 6. Okay. But what is semi-strong form? The prices incorporate past movements and publicly available information. They will get affected by insider information. Okay. So this is insider information. In semi-strong form markets, the prices will be affected by insider. So this is insider information. In semi-strong form, the price will be affected by this. So share price at the end of today. Now, about A, the decision will be announced tomorrow. About product A, the decision will be announced tomorrow. It's insider information. It will be announced tomorrow. So prices will be affected, but tomorrow. It's asking about end of today. So product B has an NPV of 160 million. It's an insider information and decision will be made this morning. So when this insider information will come out in semi-strong form, the share price will be affected. 160 million is the NPV and you have 800 million shares in issue. That means per share, this project B is generating 0.2. So share price will be affected this morning when you make announcement about product B, and at the end of today, the price would be increasing by 2, so become 6.2. What will be the share price tomorrow? Tomorrow you will announce product A. So 40 million NPV, 800 million shares. 40 million NPV, 800 million shares. That means per share you will get benefit of 0.05. So at the end of tomorrow, the price will further rise by 0.05 when this inside information about product A comes out. But it's not asking about tomorrow's share price. It's asking today's end share price. So today you announced B. So this was inside information. The price will get affected because in semi-strong form, prices get affected by inside. But if strong form efficient, no matter you announce this inside information today, tomorrow, the prices don't get affected by any of these because they've already incorporated all these 3 things. Okay, so correct answer is 6.2 in semi-strong form and 6 in weak form, strong form. For this, you need to have a sound understanding about the weak form, semi-strong form, strong form. That weak form says prices already incorporate past information. In semi-strong form, past in public, and in strong form, past public, inside information. That means in strong form, if it incorporates everything, it won't get affected by anything. In weak form, it's affected by past movement. So we'll get affected by public and insider. And in semi-strong form, it gets affected by past information, publicly available information. So it will get affected by insider information. Yesterday, your share price was 6 and board approved 2 projects 2 days back. Not announced, that means it's still inside. Product A has an NPV of 40 million. 800 million shares will get affected by 0.05 per share. This will be announced publicly tomorrow. That means this inside news will come out tomorrow. And for B, this inside news will come out this morning. What will be share price at the end of today? Okay, in semi-strong form, when this insider news will come in, sorry, strong form, when this insider news will come out, the prices don't get affected by any of these insider news as well. You just studied. So strong form, the prices will remain same at 6. But in semi-strong form, they get affected by inside. So both inside news will come out. The prices will increase by 0.2 per share and 0.05 per share. But for A, you're making announcement tomorrow. So price will increase tomorrow. For end of today, only B, 0.2 per share, 6.2 is the correct answer. Okay. Question 2, a basic question about futures option swaps. Which of the following statements about over-the-counter interest rate options are correct? So you might have studied currency futures, currency options, currency swaps, interest rate futures, interest rate options, interest rate swaps. Characteristics are same, futures, option swaps. Okay, you must learn the characteristics as I have taught you, that for futures, they are for standardized amounts, they are tradable, settlement can be done before, no physical buying, selling. And for options, it only gives a right, no obligation. Which of the following statements about interest rate options are correct? Okay, it is an agreement with a financial institution. It's an agreement with a financial institution, bank, money exchange. It can be traded. An immediate premium is payable. It must be exercised. Which of the following statements about over-the-counter options are correct? Which statements about options are correct? Now, option must be exercised. This is completely wrong. Option gives you choice. Either exercise or let it lapse. It's not a binding obligation. You see, option is not a binding obligation. It just gives you a right. It's not an obligation. So it must be exercised. Obligation, that's wrong. So when 4 is wrong, C gets out. D gets out because 4 is wrong. It can be traded. If you have studied from me or you have studied from the book, options are never tradable. Futures are tradable. Options are never tradable. Okay. In futures, you can go and see my register. I have written futures are tradable. Options are not tradable. So 2 is also wrong. When 2 is wrong, A also goes out. So the correct answer is B. 1 and 3, and these are very, very easily the characteristics of options if you have studied them properly. That option is an agreement with financial institution. Yes, we do it with the bank. An immediate premium is payable. Yes, to enter into options, you have to pay a penalty premium, because if you back off, the penalty or premium will be his. Okay, so 1 and 3 are correct. It must be exercised. That's wrong. It's not a legal obligation. It can be traded. That's for futures. Okay, so 1 and 3 is correct. Okay. Bigger company has 100 million shares in issue. Company has 100 million shares in issue and has just reported a PAT of 55 million. Okay. So 100 million shares in issue and PAT is 55 million. Okay, fine. 100 million shares in issue, PAT 55. A new issue of 50 million equity shares at an issue price of 1.5 is being considered. So you're issuing a new issue 50 million shares, issue price of 1.5. That means 50 million shares are being issued. You will issue it at 1.5. You will get 75 million. All proceeds would be used to redeem a bank loan with a cost of 8%. Now, this is a very easy question of sources of finance. I've taught you multiple questions of this. Bar company and multiply PLC, tin or TINEP company. Okay. So all these are that you issue new shares 50 million 1.5 and you redeem a bank loan, Tarwin PLC also. Okay, you redeem bank loan, interest cost goes down, profits go up, tax goes up, and your PAT increase. It pays tax at a rate of 20%. Assume that operating profit remains constant, PBIT remains constant. If the equity issue goes ahead and the bank loan is redeemed, what will be the new EPS? So you need to find a new EPS, simple. Okay. Now, if you have seen that company has 100 million shares in issue and PAT 55 million, so if you try to find the EPS now, it's PAT 55 million less preference dividend 0 divided by number of ordinary shares. Okay, that is 55 million PAT less preference dividend 0 divided by number of ordinary shares, that is 100 million. This is your current EPS. Okay, and now it's asking if the equity issue goes ahead and bank loan is redeemed, what will be the new EPS? Okay, it's asking new EPS. If equity issue goes ahead, okay, and bank loan is redeemed, new EPS if equity issue goes ahead and bank loan is redeemed. Okay, now new EPS. I will do as per my format taught in the classes. Okay, equity issue goes ahead. Funds raised. Okay, how much are the funds raised? 50 million shares are being issued. At what price? 1.5. That means fundraiser 75 million. They will be used to redeem bank loan at cost of 8%. Okay, so this will create interest saved. Okay. Okay, so what is the interest saved? So you raised 75 million. And through that, you paid off bank loan, redeem bank loan at 8%. So your interest saved is 75 million into 8%. Okay, your interest saved. That means profits will rise by 6 million. Okay, when profits will rise by 6 million, you will have to pay additional tax. When profits will rise by 6 million, you have to pay additional tax at 20%, which is 1.2 million. Okay, so profits will rise by 6, but you have to pay additional tax 1.2 million. So your net benefit will be 4.8 million. Okay, now you can find new EPS. Okay, your path is now not 55 million. You redeem loan notes to get 6 million additional interest saved, which increased profits but increased tax as well. So your net PAT, net benefit was 4.8 million. So you can get a revised EPS. Now your PAT is not 55, it's increased by 4.8. So your PAT is 59.8 million. 55 was there, and you got 4.8 million additional to this. So it's 59.8 million. Less preference dividend, no preference shares, no preference dividend, over. Number of ordinary shares are now not 100 million. You issued 50 million more shares. So it's 150 million. Okay. It's 0.398 or 0.399. Okay. 59.8 million minus preference dividend 0 divided by number of ordinary shares 150 million. Okay. 0.399. You can copy this. Okay. A project has average estimated cash flows of 3,000 per year with initial investment of 9,000. Okay, so project has average estimated cash flows of 3,000 per year and initial investment of 9,000. Depreciation is straight line with no residual value, and project has a 5-year lifespan. Okay, so average cash flows of 3,000, initial investment 9,000, depreciation is straight line, no residual value, scrap value, 5-year lifespan. The company has a target ROCE of 15% and target payback of 2.5 years. ROCE is based on initial investment. Now, ROCE is not based on average investment. It's clearly mentioned ROCE is based on initial investment. Under which appraisal methods using company's targets will the project be accepted? Whether it's acceptable under ROCE or payback. 1, 2, both 1, 2, neither 1. Now, the decision rule of ROCE. ROCE must exceed target ROCE. Okay. And decision rule of payback. Payback must be less than target payback. Okay, when I teach you 4 appraisal techniques, I tell you that the rule of NPV is that positive accept, negative reject. Rule of IRR is that it must exceed cost of capital. Rule of ROS is that ROS must exceed target ROS. And rule of payback is that payback must be less than target payback. Okay, so you need to decide that cash flows are 3,000, initial investment 9,000, depreciation straight line with no residual value, 5-year lifespan. Company has target ROS of 15% and target payback of 2.5 years. ROS is based on not average investment but initial investment. Under which appraisal methods will the project be accepted? Whether it's acceptable under ROS or payback. The rule of ROS is that must exceed target ROS. Rule of payback is that must be less than target payback. Okay, so under which appraisal methods will the project be accepted? Let's talk about finding ROS and payback. Now, if you talk about ROS, the formula of ROS is average profit divided by average investment. But here it is saying ROS is based on initial investment. So average profit over not average investment, but initial investment. It's company's policy, average profit or initial investment. This is the formula of ROS. Okay, so if I trying to find the average profit, I have told you the formula of average profit as take total taxable profit. So total taxable profit is 3,000 per year. Taxable profit is cash flow, sales less all costs, 3,000 per year, 5-year life. So total taxable profit is 15,000 minus total depreciation. So depreciation is straight line, no scrap value. So if 9,000 is the investment, that means full 9,000 will be charged at depreciation. If 9,000 is the investment, whole 9,000 will be charged as depreciation. So total taxable for 15,000, total depreciation 9,000 divided by life, 5 years. This will give you average profit as 1,200. Okay, total taxable profit 15,000 for 5 years, less total depreciation 9,000 is the cost of full 9,000 depreciation over life, 5 years. And average investment, initial investment. So initial investment is 9,000. So average profit over initial investment 200 gives you ROS as 1,200, average profit over initial investment 9,000 in 200. I could have taken average investment, initial investment plus scrap value upon 2, but that's not required. It's initial investment. 13.33% is the ROS. Okay, and when you talk about payback period, it's very simple. 9,000 is the investment and you're getting 3,000 each year. So payback is 3 years. 9,000 is the investment, you're getting 3,000 each year. So payback is 3 years. Now payback period is 3 years and ROS is 13.33%. ROS is 13.3% and payback is 3 years. So now you can check that payback target was 2.5 years. You wanted payback in 2.5 years. The investment pays back in 2.5 years. It's giving in 3 years. So payback is not less than target payback. You should reject as per payback. Okay. ROS target was 15%. You are getting less, 13%. You should reject as per ROS as well, because ROS should be greater than target ROS. So target ROS is 15. You are getting 13.3. Reject as per ROS. And target payback is 2.5 years. Your payback should be less than that, but it's more. Reject. So under which method will the project be accepted? Neither ROS nor payback. Correct answer is D. Okay. You can copy these if you want. Okay, now MCQ number 5. After that, we'll move towards an MTQ. Which two of the following are correct descriptions of working capital? So, working capital is the capital required for day-to-day operations. Normally, class is difference of current assets minus current liabilities. So, A is definitely correct. Okay, working capital is the capital required for day-to-day operations. Normally, class is the excess of current assets over current liabilities. So, it's current assets over current liabilities. Okay. So current assets minus current liabilities, you get working capital, but it's saying which two are correct. So A is correct. Working capital is the capital required for day-to-day operations. Current assets and current liabilities difference. Inventory days plus receivable days minus payable days. This is not working capital. This is the formula of working capital cycle or cash operating cycle. Inventory days plus receivable days less payable days. This is working capital cycle, not working capital. Current assets or current liabilities. This is also not, because this is the formula of current ratio. Current assets over current liabilities. It's not working capital. It's the formula of current ratio. The long-term capital invested in net current assets. So this is the only thing left. Yes, it's the capital invested in day-to-day operations. That's net current assets. Okay, so A and D are correct. Now we will move towards an MTQ. Okay, now this MTQ covers working capital management. Amex company is a multinational company which has been reviewing its working capital management. Inventory component X. Component X has a unit price of 25. Payables. There are two payables. BART company, we have to pay payables 1,000, and Colex company, we have to pay 3,200,000. Okay, so Amex is a multinational company. It has an inventory component X. Its price is 25. It has to pay to two payables, one to BART company, 1 million, and one it has to pay to Colex 3,200. Amex has received an offer of a bulk discount for bulk purchases from BART company. Now, BART company has given a discount for bulk purchase. Now, bulk purchase discount is EOQ. Bulk purchase discount is economic order quantity. Early settlement discount is that creditor management, whether to accept discount or not. Okay, so Amex has received an offer of a discount for bulk purchases from BART company, one of its major suppliers. BART has offered a 0.5% discount on orders of 60,000 units or more. So remember, I told you or more has no sense. So BART has offered 0.5% discount on 60,000 units of component X. Amex currently consumes 240,000 units each year. So demand is 240,000 units and places order of 20,000 units at the end of each month. So you place order of 20,000, but it has offered a discount of 0.5% if you order 60,000. Holding cost is 1 per unit per year. Ordering costs are 250 per order. Amex does not maintain any buffer stock, no buffer stock. Okay. Colex, a major supplier of component M to Amex, has offered a 1% early settlement discount. Now, Colex, the other one, has offered a 1% discount for payment within 30 days. Amex currently takes 72 days. Okay, but it has offered a discount of 1% for payment within 30 days. Within 30 days means 30th day. Amex has short-term cost of finance overdraft rate of 6% and no surplus cash. There are 360 days. Amex currently has decentralized treasury options, but is considering implementing treasury. So currently you have decentralized divisions, but now you're considering centralized head office. Okay. So the MTQ case is clear. Amex is a multinational company. Its inventory is X, 25 per unit. It has two payables, two people it has to pay. BART company, 1 million. Colex company, 3.2 million. It has been offered a bulk discount, that's EOQ, from BART for product X. You order product X 20,000 units. BART says that, okay, purchase 60,000, I will give you 0.5% discount. Holding cost, ordering cost is given. And the other supplier, Colex, is giving you an early settlement discount. Okay. Using months as the basis, what is the financial consequence of accepting the bulk purchase discount? So, what is the financial consequence of accepting the bulk purchase discount? Okay, so bulk purchase discount is being offered by BART company, right? Bulk purchase discount is being offered by BART company. You are purchasing 20,000 units, and it's saying that we will offer you 0.5% discount if you purchase 60,000. Holding cost, ordering cost is given. Okay. Now it's a question of working capital management, MX company, financial effect of bulk purchase discount. And bulk purchase discount is EOQ. Okay. Now, currently you are purchasing how many units? 20,000 units. And supplier is offering you discount if you purchase 60,000 units. So I have taught you in my classes that currently you are purchasing 20,000 units, but supplier is offering you a discount of 60,000 at 60,000 units. So you should check total purchase cost TPC, total ordering cost TOC, and total holding cost THC at 20,000 units and 60,000 units, and then decide. TPC, remember, it's the purchase price per unit into annual demand. Okay. TOC, C naught into number of orders. And THC, it's a CH into average stock. Okay. You get total annual cost of stock at 20,000, 6,000. This is a very easy topic, right? Bulk purchase discount, whether to accept bulk purchase discount or not, you compare what you are doing and what suppliers offer. So TPC at 20,000 units. What is the purchase price per unit of X? Remember 25 into annual demand. Annual demand is 240,000. Okay. Total ordering cost, C naught. What is C naught? 250 per order. Number of orders is annual demand, 240,000 over your EOQ, that is 20,000. Okay. And total holding cost, it's CH, 1 per unit into average stock. That's buffer stock, safety stock 0 plus half EOQ. So half of 20,000 because your EOQ is 20,000. If you add them all, okay, 6013,000. That's basically the current scenario. Okay, currently you were purchasing 60,000, oh sorry, 20,000 units. So you calculated purchase cost as purchase price per unit into annual demand. So purchase price per unit was 25 and annual demand was 240,000. Okay, so you got this purchase cost, purchase price per unit 25, annual demand 240,000. TOC was C naught into number of orders. Okay, and THC was CH into average stock. Okay, now supplier is offering you a discount of 0.5% for payment. Oh, sorry, supplier is offering you a 0.5% discount if you purchase 60,000. So you need to find TPC, THC, TOC on 60,000. Okay, now THC is very easy. CH 1 to average stock, buffer stock plus half EOQ. Now EOQ is 60,000. So 60,000 divided by 2. Okay, it's 30,000. TOC, C naught, 250. Number of orders, it's annual demand 240,000 divided by now EOQ, 60,000. Okay, total purchase cost. Purchase price per unit is not now 25. 0.5% discount, so it's 99.5%. Okay, it's not 25, it's 0.5% less. Okay, 99.5% into purchase price per unit into annual demand. Okay, if you add them all, So if you are ordering 20,000, your cost is 6013. And if you're ordering 60,000, your cost is 6001. So is the cost falling? Yes. That means financial impact of accepting the bulk discount is the benefit of difference. Okay. So considering this, the answer should be okay, benefit of 12,000 per year. Option B. Very, very easy question of working capital management. That you have been offered a bulk discount for 60,000, but you are purchasing 20,000. So compare TPC, THC, TOC at both and then decide. Okay, if you want, you can copy this, please. Okay. Using days as the basis, what is the financial consequence of accepting the early settlement discount? No, this is accepting early settlement discount. Remember, creditor management, whether to accept discount or not, it's accepting early settlement discount. Okay. Now, early settlement discount relates to collects. Yes. Colleagues, a major supplier of component M, has offered 1% discount for payment within 30 days. Amex currently takes 72 days to settle outstanding invoices with Colleagues. Okay. Now, currently, it takes 72 days to settle outstanding invoices. It is offering you 1% discount for payment within 30 days. Okay. Number 2. Now, trade payables. Colleagues is 3,200,000. Trade payables collects is 3,200,000. Okay. And payable days collects is 72 days. Okay. Payable days collects is 72 days. You currently take 72 days, and trade payables collects is 32,000. Okay. Now, whenever you have payables and payable days, okay, remember the formula of payable days. The formula of payable days is trade payables divided by credit purchases or cost of goods sold into 360, right? The formula of payable days is trade payable divided by credit purchase into 360. Now you have the payable days 72. You have the payable days 72. And you have the trade payables 3,200,000. You can simply rearrange this formula to get credit purchases. Like payable days are 72 equals trade payables are 3,200,000. Okay. Divided by X credit purchases into 360. So you can easily rearrange this formula to get the figure of X credit purchases. So 360 goes there, divide 0.2, that's 16 million. Okay. Okay. So why did I calculate purchases figure? Because the discount is not offered on payables, it's offered on purchases, right? Even you can see above, the bulk purchase discount was offered on purchases figure 25. So here also, it's general principle, discount is never offered on payables, it's offered on purchases figure. So you have the trade payables of Colex 3,200,000, and you have the payable days of Colex 72 days. Okay, you can find payable days, trade payables, or credit purchase into 360. Put credit purchases X, you got purchases figure. Now, Colex is offering you a 1% discount for payment within 30 days. Okay, and normally you take 72 days. Overdraft is 6%. Whether to accept discount or not. Now, those students who have studied from me, okay, they know how I've solved it. I used to make two columns in creditor management: accept and reject. I used to make two columns in creditor management: accept and reject, whether to accept early settlement discount or not, accept and reject. Now, if you reject discount, you have to pay the full purchase bill, that is 16 million. Okay. But if you accept discount, you have to pay not full 16 million, but 1% less, 1,584,000. Remember, if I accept discount, I have to pay 1% less, 1,584. But if I reject, I have to pay full 16 million. If I reject, I have to pay this amount full in 72 days. I have taught you this. If I accept, I have to pay this 1,584,000 on 30th day. Remember, if I reject discount, I have to pay the full purchase figure. Why I calculated purchases figure? Because discount is always on purchases, not payables. So if I reject discount, I have to pay full 16 million on 72nd day. But if I accept discount, I have to pay 1% less, 99%, 1,584 on 30th day. But rejecting discount produces an interest income as well. What? You will keep this 16 million for how many extra days? 42 more days, because if you accept, you pay 30th day, but if you reject, you pay 16 million on 72nd day. So you keep the 16 million for extra 42 days. You can invest it at 6% for extra 42 days out of 360. So you get interest income as well. Remember, 16 million invested at 6% for extra 42 days. You get interest income also for 112,000. Okay, that means your net cost, if you accept discount, will be 1,584,000. But if you reject discount, it will be 16 million, but also create an income for you of 112,000. So your net cost is going to be 15,888. So rejecting is producing a higher cost. Accepting is producing a lower cost. What is the financial effect of accepting early discount? The financial effect of accepting early discount is that your cost is being saved. You are getting a benefit of how much? Take the difference. 48,000. So the financial effect of accepting early settlement discount is 48,000 benefit, and this means you can go in question number 2 and benefit of 48,000 should be ticked, option A. Okay, if you want to copy, you can copy this as well, please. Okay, question number 3. In relation to managing foreign accounts receivable, which of the following statements is correct? Companies expecting to receive foreign currency from foreign accounts receivable will be concerned about the risk of foreign currency appreciating against domestic currency. A big wrong statement. Companies expecting to receive money from foreign receivables in foreign currency will be concerned about foreign currency appreciating. No, they will be happy about foreign currency appreciating, because let's suppose I'm in Pakistan and I'm expecting to receive $1,000 from a foreign receivable. I'm receiving foreign currency, $1,000 from a foreign currency. I will be not concerned that foreign currency appreciates, dollar gets appreciated, because if dollar gets appreciated, I get more money. Let's suppose dollar is 200 PKR to a dollar. So I will be concerned about dollar falling, that it becomes 190, I receive less money. If it becomes 180, I receive less money. But I won't be concerned about foreign currency appreciating, because I will be receiving $1,000. If dollar appreciates, becomes 220, 240, I receive more money. Okay, so this is wrong. The safest way to conduct business with foreign account receivable is by making a sale where goods are shipped and delivered before payment is due. See, a big wrong. The safest way to conduct business by foreign receivable is by making sale where goods are shipped and delivered before payment is. So the safest way is to send them goods, ship them goods, deliver before payment. This is the dangerous way, not the safest way. Third, there is no need to assess the credit worthiness of foreign customers if a company has export credit insurance. There is no need to assess credit worthiness. This is also wrong. So correct answer is D. In relation to Amex proposed changes to treasury management. Remember, they were proposing changes to treasury management. From decentralized, they were going to centralized. From decentralized power at divisional level, they were going to centralized. In relation to Amex proposed changes to treasury management, they were going from decentralized to centralized. Which of the following is true? Local management will be incentivized to maximize profitability. You are not understanding the statement. Okay, local management will be incentivized to maximize profitability. When you are going to centralization, local management doesn't have power. So wrong. Amex company will be more responsive to localized needs. No. When you're going towards centralized, head office has the powers. You won't be responsive to local needs because the power now is not at local level, it's at head office level. Amex will suffer loss of autonomy at local level. Yes. When you move from decentralized to centralized, the advantage of decentralization is that autonomy power goes at lower level. When you're going towards centralized again, the local level power goes. The change should increase the cost of hedging foreign currency risk. Okay, so obviously currency risk was previously also faced by head office, now also, so it should not change the cost of hedging. Question number 5 is a very easy question in relation to working capital funding. Now you have studied two strategies: working capital investment and financing. A working capital investment strategy and financing strategy. Which of the following statements is correct? It's relation to working capital funding strategy. Remember, in financing strategy also aggressive, moderate, conservative, and in investment also conservative, moderate, financing. Aggressive. An aggressive strategy seeks to maximize liquidity at the expense of profitability. Short-term finance has a higher cost than long-term finance. It's not necessarily the case that short-term finance always has a higher cost. Fluctuating current assets should be financed from short-term. This is written in my notes, that permanent through long-term and fluctuating, which you only need for a short time period, they should be financed from a short-term source. Okay, so I have solved 10 MCQs with you here. This is MCQ session number 6. Do watch the previous 5 videos as well, as I told at the starting of the session. Okay, you will get a real benefit. We are ending the class here. Take care. Thank you.